Back. We're here. Excited to be here. Okay, who's completely fried? It's 4:45. Are you ready to learn? We've got some exciting topics here. We're going to talk more about regulation. We're going to have some fun. We're going to get into digital risk. So let's jump into it. Digital risk and the risk rating gap. And I believe this is really the single most important regulatory variable for future institutional adoption of Bitcoin. So let's unpack it a little bit. So Basel III, you've probably heard this a couple times now, which is post 2009 banking regulatory reform. So after the 2007, 2008 financial crisis, the G20 came together and they talked about how can we improve our capital markets? How can we improve capital quality? How can we improve liquidity? How can we remove excess leverage and make sure that whatever just happened doesn't happen again? So they came up with the Basel III standards, which is the risk weightings that you see on the screen here today. So let's walk through them. We've got Basel III risk weights: gold, 0%; government bonds, 0 to 20%; mortgages, which almost took down the entire global financial system in 2008, 35 to 100%; corporate loans, 20 to 100; public equity, 250; and Bitcoin with 1,250%. So Bitcoin is 5 times more risky in the regulatory eyes than public equity. That's interesting. So what's the purpose of the risk weightings, right? Not all assets are created equal. So there's got to be some framework to protect the capital on a bank's balance sheet, so there isn't excess leverage in the system, so there's no collapse into the future. So what does that do? Like, what does this look like, right? So here's some risk weighting regulation incentives. So this is a pro forma balance sheet. We're going to just assume this is a bank that's holding some assets. So these assets, you've got cash, 10 million, treasuries, 30 million, mortgages, 40 million, corporate loans, 15 million, and Bitcoin at 5 million. And you see the furthest column over to the right, the risk weighted value: 0 for cash, 0 for treasuries, 20 million for mortgages, 15 million for corporate loans, and 62.5 million for Bitcoin. So if you've got a $100 million balance sheet and this is your risk weighting, you'd have to hold $97.5 million against that $100 million. Now, if you pull Bitcoin, if you pull that entire line item out, you now have $35 million of risk-weighted value against $95 million of capital. So a 5% allocation to Bitcoin currently would triple the capital requirements that a bank needs to hold. So as you can see, there's no way that a bank would hold Bitcoin on their balance sheet because they can't lend against it, and they would have to hold excess capital against the instrument on the balance sheet. So does this make sense? Let's do a structural comparison of the US dollar, gold, Bitcoin, and public equities. So let's just run down a few of these. Supply control, right? We know that there's 21 million Bitcoin. How many US dollars are there? Unknown. Gold, unknown supply. You can mine it on asteroids into the future. Potentially we're able to make more of it via chemistry in the future with AI. Public equities, obviously, they're paper contracts they can dilute. Monetary policy, fixed with Bitcoin. Transparent. Bitcoin, you can see every single transaction that happens on the ledger. Incredibly transparent. Settlement happens instantly with Bitcoin. Custody and risk, it's a bearer asset. You can actually hold it. Gold gets a gold yellow star here. Debasement, Bitcoin can't be debased. Sovereign risk, there's no debt associated with Bitcoin, right? The US dollar has got $38 trillion of debt associated with it. And so then you compare all of these things and you look at the risk weighting on the bottom. And that starts to bring up some questions, right? Does that make sense? How do we think about that? It's a bit odd. So what's the problem? What's the fundamental problem? Bitcoin is lumped together with all of crypto. And I'm sure, as everybody knows in this room, Bitcoin, not crypto, right? Bitcoin is an asset without an issuer, whereas all of the other coins in the entire crypto ecosystem have fundamentally different designs, and they have people that are controlling the particular instruments. So there's a ton of education that needs to be done on the differences between Bitcoin and crypto, but then also talking about the risk profile as we walked on the last slide. So how do we start to think about this? Just gonna have you watch the GIF here for a moment. These are from Check on Chain, and this is 30 different charts out of the 2,000 charts that he has on his website, looking at every single component of Bitcoin over its timeline. You could look at different wallet transactions. You could look at how long Bitcoin has been held. You can see how it moves. And this is just one analyst in the world of the thousands of analysts that can be looking, and thousands of analysts and AI agents that can be analyzing the transparent data 24/7, 365. So why is this important? Bitcoin is just incredibly observable. And there's, in my opinion, that observability allows you to calculate that risk much easier than anything else in the market. And right now, that transparency is being punitive. The regulatory environment is punitive against the transparency. So it is volatile, yes, but it is incredibly observable, fully auditable, and unmatched amount of data. So let's talk about the digital credit frontier, because this is a function of this, right? We've got the capital environment is very punitive against Bitcoin. So how do we start to think about this from a digital credit standpoint? So we got two components here. Now, with traditional credit, you've got quarterly reporting, 90-day lag. You've got opaque assets that are sitting on the balance sheet. The balance sheet statements that come out every quarter, they're backward looking. The businesses are only open during business hours. You can't call anybody and see, what's going on with the company. So every time you get a quarterly report, you have to re-rate the entire balance sheet. You have to re-rate the entire company. You have to re-rate the entire risk profile of the instrument. And during that time horizon, each quarter, it's trading off of asymmetric information. So that makes these instruments just inherently illiquid, because you have a lack of information on the actual risk of that instrument. Now enter digital credit. Incredible innovation where you have real-time Bitcoin price, so zero lag on any of the data or the information you have. You have 100% transparent collateral. So every transaction that happens, as you saw on the last slide, you can see it. You can see how the monetary system is moving and changing and evolving. And you can continuously monitor this. You can look at the NAV coverage, right? I think Strategy's they've got a website that's updated every 10 seconds or 15 seconds, where you can see the capital on the balance sheet, how much leverage on the balance sheet, what's the relative risk profile, how do the instruments fit next to each other, and all this stuff can be calculated 24/7, 365. You could wake up at 3 o'clock in the morning on Sunday and calculate the risk of the instrument that you hold and make a decision based on that information when the markets are open. And that's that's never existed in the history of capital markets before. And that is an interesting component of these instruments and will result in increased liquidity in these things, because the risk profile is fully observable 24/7, 365. So how do we start to think about the risk profile of these things? And I've got an insurance background. I talk about insurance all the time. I'm a total risk nerd, and I see this in a couple different ways. So you can look at a backward-looking view, an experience rating, and then you could look at an exposure view, looking at a forward rating. So how do we start to wrap our heads around this? And what's the frontier? What's the tip of the spear in the risk world? So let's think about experience rating. I've got some cool, sparkly, colorful graphs here. And on the left-hand side, this is looking at a digital credit balance sheet as if it were to start every single month. So what would that balance sheet look like over time in past history if it were to start on a different month every month going back for the last 10 years? And you could go see the performance of that balance sheet. Like, how would the collateral in that balance sheet perform over time? And you can start to analyze that data and information, right? This is a very observable asset where you can create entire profiles of data and information that can be analyzed. And over on the right-hand side, this is taking a balance sheet at a point in time, looking at an amplified Bitcoin model and applying it over history and comparing it to what if I only had a spot model? What if I had an amplified Bitcoin model and I've got a spot Bitcoin model? And what's the discrepancies between the two? And based on past cycles, past bear market cycles, different points in time, how would the balance sheet have performed? Would there be a point in time where there was not enough capital on the balance sheet to pay out the dividends into the future? Would there be a point of time where I would be concerned about the credit quality of the instrument that I hold? And that's interesting. You can do this analysis. You can run this data and information. And I mean, based on the keynote this morning, apparently agents can start to pull together the visuals and make decisions on this information. But this is just one view, right? I'm sure many people in the audience can start to think of different ways to backtest this information and create different risk curves and identify different probabilities of loss at different points along the risk curve. So that brings us to the forward-looking view, an exposure analysis. So how do we price risk forward, right? Like we can look backwards. Now let's think about this into the future. So into the future, what you see on the screen here, this is a occurrence exceedance probability curve. And there's 4 different probabilistic models on the screen right now. And these 4 different probabilistic models have different assumptions that go into them. So they take all of the data from past Bitcoin cycles and Bitcoin history, different volatilities, different jump diffusions, so like different regimes, when there's bear market regimes and bull market regimes, and you could take that information and extrapolate it into different probabilistic simulations, and you can run 10,000 simulations, 20,000 simulations, 100,000 simulations to get an occurrence exceedance probability to understand the probabilistic downside over a period of time. I think this is incredibly interesting. You can calculate what the probability of loss, or the probability that at the end of a certain period of time, how much capital is on the balance sheet with X% probability. So what's the 1% downside? What's the 0.5% downside? What's the 1 in a 100-year loss that I could have? You cannot do this with traditional credit. This is very difficult to do with traditional credit because it's not observable. You don't have an understanding of the future of the business. So this is just a numerical view of this. So this is what an occurrence exceedance probability table looks like. I used to deal with these all the time in my reinsurance life. But so you could see it at a 1% downside. You could look at the probability of collateral coverage at the 1% downside. But you can also look at the upside of the curve. What does my balance sheet look like on the upside? What does it look like at the mean? What is the variance in that model? What is the standard deviation in that model? You can compare all the different probabilistic models next to each other. You can start to take conservative views of risk. Maybe I need to leverage up my balance sheet higher because I have very low probability of risk. Maybe this helps me frame and conceptualize the risk profile of my entire balance sheet and help inform decision making. So I think this is really the frontier of where the risk analysis of this industry goes. And again, this is just one example of an ex-reinsurance broker that used to work with actuaries all the time, trying to rebuild a risk model in the new frontier of digital credit. So what's the takeaway, right? The takeaway is that the tools exist, the data exists, we need to build the framework. And I encourage everybody to think about how can we start to think about the risk profile of these things and communicating them, because one of the biggest takeaways I get from most people is like, how risky are these things? Do I want to hold them? How does it make my portfolio better? And being able to communicate that on an institutional level, wearing a suit, walking in the door, talking about occurrence exceedance probabilities, probabilistic models, speaking their language, I think that goes a long way. So we can observe all this information 24/7, 365. There's historical risk tools built in the insurance industry and the traditional credit industry. We can use those and apply them in a new way with a completely transparent balance sheet. And ultimately, that should lead to regulatory evolution. These things are incredibly transparent, and you can calculate the risk 24/7, 365. So we have better visibility into Bitcoin-backed preferreds than anything in the traditional market. And if the US wants to be a leader in Bitcoin, there needs to be some reform at the regulatory level, allowing Bitcoin to be treated as an asset with less risk than it's currently being treated at. So that's all I've got. Thank you very much. Appreciate it.